Welcome to Retiring Well. We've got a great show lined up for you today. We've got topics such as PE ratios, where we're going to be talking about stock buybacks, and we're going to be talking about active versus passive management and how those might play a role for you, as well as when do I need a trust? Everyone questions wills, trusts, what makes the most sense for your estate plan, as well as 3 success questions when it comes to your income plan and in-service rollovers. So stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Welcome back. In this segment, I want to talk to you about stock buybacks. Why do companies do them? Well, one reason they might do it is to give their key execs some bonuses, right? They buy their stock back, give it as a bonus. But there's another reason sometimes they might do this. It's regarding price to earnings ratios. Now, just to show you how this works, this is a stock selling for $100 per share, all right? And let's say its earnings per share is $5. That's going to be a PE ratio of 20, the stock price divided by its earnings. Now, why is that an important number to understand with stocks or funds? Because the market historically is traded at about 16, 17 times earnings. So if you have a PE ratio higher than that, you might have one that's, maybe a little overvalued. What you want is a low PE ratio. So, take this company. It's got earnings of $4 million. It's got 100 million shares outstanding, meaning there's 100 million shares out there that people can buy or own. If you take the earnings divided by the number of shares, it gives you $4 per earnings. All right, so if I take that $100 stock price and I divide by the $4 in earnings, I'm now getting a price to earnings ratio of now 25. Now it's a little bit high, right? So what might this company do? Well, let's say it buys back some of its shares. So it's going to buy back, let's say in this particular case, just so we can understand it, let's say they buy back 20 million shares, all right? The earnings don't change. The company's still only making $4 million, but now they only have 80 million shares outstanding. If I do the PE ratio on this now, what am I going to see? If I take that 80 divided by the 4, now I'm basically back up to a PE ratio of 20. Now, why is this important to understand? In this corporate stock buyout, listen, my earnings didn't change. Was my company really any healthier? But by buying back that stock, it made me look like it was. Now, you're hearing a lot about this in the news, corporations buying back their stock. What would we rather see them do with those earnings? Well, pay them back in dividends to the shareholders might be a nice thing. How about they, reinvested into research and development or capital expenditures that might make their company grow? Now, companies do that, but what the concern is and what you're hearing in the news is when they're doing this and it's not really improving their earnings much, maybe not so good. So anyway, I hope that kind of educates you a little bit on why they do that and especially how it's affected with PE ratios. Folks, we have the ability to take any portfolio and actually calculate as a whole what the PE ratio is of that portfolio. Very important to understand, especially if it's kind of way above the historic averages. So I encourage you, if you're somebody who really wants to know that, give us a call.
Hi, my name is Jack Clunder and I'm a financial advisor with Centennial Wealth Advisory. My wife and I moved up here 13 years ago, and we have really enjoyed raising our 4 children in the beautiful northern Michigan country that we have. If you've been watching the show for a while, you know what we specialize in. If you are at retirement or near retirement, give us a call. Call the number on your screen. We can help go through all the different aspects of planning that are involved in retiring well. So I look forward to hearing from you.
Hi, welcome back. Listen, in this segment, I want to talk to you about what is called passive investing versus what we call active management. 2 different things, folks, and there's something you're going to want to be very, very aware of. First of all, one thing that's out there that's it's growing in popularity is what we call ETFs, or exchange traded funds, okay? Like these, like a bucket of securities, all right? And basically, once you put all those securities in that bucket, that bucket closes. Okay? There's no longer any trading happening on it. It's basically like an index. You're just basically tracking that bucket of securities. That's what an exchange traded fund is. Now, they trade on the New York Stock Exchange just like a stock does. They're highly liquid because you can buy and sell them right on the exchange. But basically, it's passive because there's no trading anymore going on with that account. That bucket, that ETF is going to hold those securities no matter what until you sell it. Okay, so you might find if there's no changes happening, then that's probably leaning more towards, you know, a passive account. The other thing is when you look at a mutual fund, for example, all mutual funds have objectives, okay? Meaning they have an objective to hold certain securities in that fund, in that account. Okay, now unlike an ETF or an exchange traded fund, there's trading going on within that account, okay, based on that objective in the securities they hold. For example, let's say I'm in what I call a large cap mutual fund. That's simply a mutual fund that has to hold large company stocks. That's what its objective is to do. And so that fund manager is going to buy and sell large company stocks within that portfolio. Now, even though that change is happening, you've got, you know, some management happening with that. It's somewhat passive in the sense that it's only going to hold those securities that it holds. All right. Now, the key factor to understand when you're dealing with ETFs or mutual funds is understanding what they hold and what they're going to do when market conditions change. Because if all you're holding is certain sectors or certain asset classes and you don't have effective diversification, then it's going to be very passive because it's not going to change up a whole lot. Okay? Now, active management, these are going to be fund managers or portfolios that are actually going to change with the market conditions. They might not be held to objectively hold any particular assets within their portfolio. If they see interest rates rising and bond values maybe going down, then guess what? They can change that up. Maybe they can lower their exposure accordingly. All right? But what you want, when market conditions get such that, especially as we approach recessionary times, you're going to want to be careful what kind of account you're in, because you may find it necessary to maybe be more in accounts that are active that can change up rather than be passive. So if this is a concern for you, something that you want to understand more about, then I encourage you, give us a call because we'll gladly take a look at that for you.
Wow, John, 2 really interesting topics that Larry just went through. First one, that chalk talk there, PE ratios. I know that's a complex topic that, you know, a lot of people hear about, but I think don't really understand. So hopefully, you know, Larry was able to kind of walk through that. I know, John, the year 1982 kind of sticks out for you. I was already born a year sooner, so I think we had something to do with that rule coming along for no stock buybacks until 1982. That's so right. They know we were up and coming in the industry at that point. So, but active and passive management, you know, it makes me think about that. Larry just talked about that. I literally just sat down with some folks here in the Traverse City office, and we walked through kind of what was inside their portfolio. So they had watched the television show, called in, wanted a second opinion, sent in their statements in advance, and we were able to walk through that. And it was interesting conversation, John, because they had been with this advisor for 10 plus years, didn't really understand anything they had in their portfolio, just kind of trusted the person, which isn't uncommon, right? But they all along had been thought or been told and thought they had an actively managed portfolio. So when the markets were up, maybe they would move around, and when the markets were down, they would not. But it was 100% passive, meaning they've had the same positions in their portfolio for 10 years.
Oh wow, yeah, and that's sometimes the case. I mean, where you don't necessarily want to have all in passive or all in active. Sometimes it's a blend of the two, and when you're looking at typically your more passive strategies, that might be where you want to just track a particular index in the market. So you could buy an exchange traded fund, an ETF, where you're simply tracking the S&P 500 or the NASDAQ, or maybe it's the technology sector as a whole that you want to track, and so you can have a more passive strategy. But then it's also something that we look at regularly of what about if you have a piece that's also actively managed, meaning, hey, when times are shifting, the economy or the stock market is moving, you're also making some adjustments to try and match up with sort of what's going on within the current economy.
Absolutely. And that's a really good point. It doesn't have to be an either or, and that comes to a lot of things. So if you're wondering maybe what you have or maybe what would work well for your retirement plan, give us a call at the number on the screen. We'd love to sit down with you at a no obligation, no cost, second opinion, and hopefully help you plan to retire well.
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review.
Listen, in this segment, I want to talk to you about trusts. Now, I am not an estate planning attorney. We'll have these conversations a lot with our clients. We can at least kind of direct traffic. But I want to give you some reasons that you might want to think about a trust. Now, this is all-encompassing. There's going to be several reasons, but I just want to give you primarily 4 that I can think of that you might want to be thinking about. First of all, most times people have a trust, and we use this in the past quite heavily when we are trying to avoid what's called estate taxes. Okay? Now, I'm not going to go into a lot of depth with that because today individuals can pass on a whole lot more than they used to be able to without any estate tax. As an example, an individual can pass on $11 million with no estate tax. If they're married, that's $22 million. Now, the only exception to that is IRAs, because IRA money has never been taxed. But that's not going to affect a whole lot of us, is it? Another reason you might want to trust is to avoid probate. A good estate plan is where all your assets know where to go when you die. All right? If they all know where they got to go when you die, then nothing has to go to probate. That's a good estate plan. It used to be that some assets had to be put into a trust to avoid probate. Okay, for example, a house. But today, with the use of Lady Bird deeds, we can set that beneficiary designation on the house so it knows where to go when you die. Doesn't necessarily have to go through a trust. But there may be assets that you need to put into a trust per se for that reason. Another reason you might want to trust is maybe you have a beneficiary that has special needs, and they're not allowed to have certain assets, or it affects their, let's say, their aid. Well, you might be able to put that into a special needs trust whereby it doesn't count in their assets, but it's money that still can be used for their care if they need it. Now, another reason you might want to trust is if you want to make, let's say, distribution elections after you die. Okay? Now think about this. If you pass away and you leave somebody a lump sum, they have full access to that lump sum right away for whatever reason. What if it's somebody that doesn't handle money very well, and you're concerned that they would maybe make bad decisions accordingly with it? Well, if you put it into a trust and then dictated how they could use that money, like maybe for just education, health, maybe their living expenses, then a trust would be appropriate for that. Maybe you have a younger beneficiary that couldn't handle a lot of money at the age they're at right now, and maybe you want to put it out there so that they have to wait till a certain age, let's say maybe like 30, and they might be more established. This is how you can make those distribution elections in a trust. So I hope that kind of gives you a feel for some reasons why you might need a trust. So I encourage you, give us a call. There's no cost, no obligation to sit down and talk and let us help you see where we might be able to direct traffic in helping you have a good estate plan.
Hi there, my name is Nick Greenman. I'm one of the financial advisors here at Centennial Wealth Advisory. Brand new to the Gaylord office. I'm here full-time now, and I'll also be commuting back to the Petoskey office as well. I'd love to hear your story and learn if I could help you manage your retirement needs.
Three retirement success questions you must be able to answer. First of all, you have to know how much income you need or want in retirement. Now folks, a lot of people will start with what they're making as they're working, right? Wouldn't it be nice if you could enter into retirement making as much as you were when you were working? That would be ideal, right? And that would be a great place to start. But what if we have to kind of put the pencil to the paper, as they say, and kind of nail that number down a little bit? That would be highly recommended, because if we're going to do an income plan, we have to know what income we're planning for. So the first question we have to ask is, how much income do we want or need? Let's start with that number. The second question we want to ask is, how much income can I count on that's guaranteed? All right, there's only a few sources of what we would call guaranteed income. There's Social Security. It's backed by the U.S. government, so hopefully that's going to be good. You've got pensions. Okay, they're going to be guaranteed by either a government or some company. Now, hopefully it's a company that's got good credit quality that's going to be around for a while, because maybe it won't be guaranteed, right? But these are sources of income that we can hopefully count on. Another one might be an annuity, like a TIAA-CREF or something that's spitting out a guaranteed income. But this is, if we answered the first question, how much income do we want or need, and then we can answer the second question, how much income can I count on to be guaranteed to be consistently coming in, the last question we have to answer is, where am I going to make up the difference? Let's say I want or need this number, I know I can count on this, but what's that? Where's that going to come from? Folks, that's going to have to come from your retirement savings. These are all those accounts that you've been hopefully putting money into to save for retirement. Those IRAs, the 401ks, the 403bs, the 457s. And by the way, all those numbers, all they are is IRS tax codes, okay, showing those sections. So if I know what I want or need, I know what I can count on, and I'm going to try to make up that difference, how do I know how much that difference needs to be? All right. As a general rule, when we're pulling from retirement accounts, we like to use what we call the 4 or 5% rule, meaning that's how much of our savings we can pull and count on for income. Now, it's not brain surgery, because if we can get an account to grow by 4, 5, 6% while we're pulling out 4 or 5%, then that's going to work all day long. But most important, as you can tell, I'm going to have to be sure that that's a consistent income that I can take. So folks, those three questions have to be answered. And then once we answer them, putting that together in a plan that also accounts for inflation is going to be very important. So if you're somebody that wants that kind of planning, want an income plan, want to know if you have enough for retirement, then please give us a call.
Art, I'm really glad Larry brought up this topic of whether or not you need a trust. I know it's something where, full disclosure, we're not estate planning attorneys, but it's a common question that we get when we're talking to folks that are either near or in retirement, and the topic of a will versus a trust and sort of what role that plays. And one of the key areas that I've seen lately is for a lot of individuals that have maybe extended family, maybe they don't have children, but they have extended family, they have different charitable organizations that they want to make sure that those assets get dispersed appropriately upon their passing. And so that's a way where a trust, can come into play. And that way, if you need to update the trust throughout your lifetime, then you can easily go and update that document, making sure that then those assets upon your passing would go to those different individuals or organizations that you want to. Now, with that, though, as we all know, it can be a little bit more costly. There are definitely costs to getting a trust established, and so that's where you want to sit down and talk with maybe a couple of different estate planning attorneys just to get their input and find out what they would ultimately charge you.
Yeah, absolutely, John. It's interesting when you're talking about trust, how important it is to have a holistic approach to your whole financial plan. Having a trust or a will or whatever that may be is definitely a big piece of that, but having them all together with a financial plan and income plan and stuff like that is vitally important. So all the pieces work together. So often we've had situations come in where maybe they have this great estate plan, but it's not funded. There's nothing in the trust, and it's a great on paper, but guess there's nothing in it. Well, that doesn't do any good. So make sure that you're working together, having your estate plan with your financial plan and all those pieces together. As Larry then talked about with the 3 success questions, the income thing, as we just talked about, having that rock solid retirement income plan is vital. Knowing where to draw your money out, how much, and all these different factors that may play a role in that. We've said this time and time again, but I cannot stress how your 401k statement is not an income plan.
Right, most definitely. And that's where, again, you want to be looking at your entire retirement plan, and you want to look for consistency when it comes to your retirement plan. So stay tuned. We've got a lot more coming up.
What are these expense ratios you find in mutual funds? Most importantly, how much risk can you take on? I want to talk to you about Social Security, the estate tax exemption, ladybird deeds. What are they? Modified adjusted gross income, tax bracket optimization, the sunken cost trap, 529 plans, the financial cycle, the Federal Reserve, income planning, tax planning, holistic planning, fees, bonds. Can I retire? We here at Centennial Wealth Advisory realize that everyone has been affected by this coronavirus in one way or another. We watch our retirement accounts drop significantly in value, and we have questions. Can I retire in a recession? How will the coronavirus affect my retirement? How do I develop an income stream in a recession? Can I still retire this year? If these are concerns of yours, contact us today for a free initial consultation and learn what you can do now to help you weather the storm. Simply call 888-608-5825 or visit sunwealth.com and let us help you plan to retire well. Hi, welcome back. Listen, in this segment, I want to talk to you about what's called in-service rollovers. If you're in a 401k plan, maybe a 403b plan at your job or your work, what you're going to want to know is it possible for me to roll that money over from my 401k, 403b into an IRA, or even my own existing IRA if I have one? Knowing this is very important. Now, many people believe that they have to wait till they're done working before they can do that. But you'll be pleased to know that a lot of plans will let you do it before you're done working. Some will say, well, you can do it at any time, which would be desirable. Some say you might have to wait to a certain age, let's say 59 and a half. And again, like I said, some might make you wait till you're done. But knowing whether you can do it or not is going to be very important. Why? Well, as you're aware, when you're in a 401k, 403b plan, your investment options are going to be limited. The plan administrators do this because they don't want you to have 1,000 different choices. That makes their administration much, much harder. So they're going to limit how many choices you have. But what if I'm somebody who wants more choice? Maybe I don't like the choices they've given me. Then I'm going to want to maybe get it over into an IRA where the whole world is available to me. Because anything an IRA can be invested in is going to be open to me. My choices become greater in that environment. So it's going to be important for you to call your plan administrator, find out. The question you might want to ask them is say, listen, I have an IRA. When am I allowed to take my money from my 403b, 401k and roll it over into the IRA? And they're going to tell you when you can do that. So knowing that is going to be very important. Now, a lot of people will ask this question. Larry, if I do that, do that rollover, is that going to create a taxable event? I can assure you that that is not a taxable event. When it's a rollover, it's going from one custodian to the other custodian. You're never receiving the money. So in that kind of event, there's no tax consequences. As a matter of fact, there's not even any reporting that has to happen because you never took custody of it. So again, check with your plan administrator, see what they allow, and then if you're somebody that can do it or wants to do it, then give us a call, because then we can show you those investment options that you might not have right now that are available in an IRA. I mean, you can have an IRA invested in gold. You can have an IRA invested in silver. It can be invested in real estate. There's a number of things that it can invest in, may be more appropriate for you under the circumstances. So give us a call.
All right, welcome back. What a great segment there on in-service rollovers. You've heard us talk about these for years, and they can be very complex, and it's important to know there's big advantages and some disadvantages to potentially doing those. So it's vital, just like any financial discussion is, to make sure you understand what you're doing. There's no one silver bullet out there, and like I said, advantages and disadvantages to both sides. You know, when you look at the advantages of a 401k rollover, there's potentially more availability on the other side of an IRA, more investment options, more planning, more advice, stuff like that. Some disadvantages, the cost may be higher depending upon what you're doing. So once again, as you're going through those options and working with a financial advisor, having those educational discussions, you know, John, I always say, you know, our job as financial planners is to educate people and help them make good decisions. We bring our expertise alongside of you and walk with you along those, because, you know, when you educate somebody, they feel good about a decision and they can sleep good at night. There's never, I don't know of a worse feeling potentially out there. If you make a financial decision and then you can't sleep at night wondering if you made the wrong decision, that could be devastating for your plan.
Right, and that's what I look at, Art, is a lot of times, just like you've been working all the time, and now you're left with this 401k where you're like, I don't really know what I'm doing potentially, and you're just picking investments, or maybe you have some help along the way, but you're really leaving your entire retirement plan up to a chance and everything. And so that's where, again, an in-service rollover would be an opportunity where you could meet with a financial professional, work alongside them to help come up with a plan to not only just focus on the investments, but again, looking at your investments and the taxes and the estate planning and all those different areas that make a good, sound retirement plan. So thanks again for tuning in to Retiring Well, and we look forward to talking to you sometime soon.